Let's take a look at a question where a bond is issued at par. In this question, Beansprout Corporation issued $500,000 of 8% 10-year bonds on January 1st, 2020 at face value. The bonds require annual interest payments each December 31st. Costs associated with the bond issuance were $25,000. Beansprout follows ASPE and uses the straight line method to amortize bond issue costs. Prepare the journal entry for the January 1st, 2020 issuance and the December 31st interest payment and bond issuance cost amortization. All right, let's take a look at what we have in this question. So we know that there were bonds that were issued that are $500,000 and they're 8% 10-year bonds. And they were issued on January 1st, 2020. And this is really important here where it says at face value. So we know that we actually got in the cash of this $25,000 because it is at par. So there's no amortization of a premium or a discount that we need to think about in this question. So should our journal entry simply be debit cash credit bond payable for $500,000? That would seem logical, but there's one additional piece of information that we need to be really careful to pick up in this question. It says that there were bond issuance costs of $25,000. So what happens to bond issuance costs under ASPE? Well, bond issuance costs are going to be netted against the cost of our bond, or the value of our liability, I should say. So we know we've got a $500,000 bond and we got in cash for this, cash in, but we also paid out $25,000 of issuance costs, which is cash out. So rather than putting this $25,000 through our income statement right away, we're going to net it against the value of the liability on our statement of financial position. So we're only going to end up with a bond payable on the issuance date of $475,000 because we're netting the cash that we got in from the bond of the $500,000 and the cash that we had to pay out to issue the bond at $25,000. So we net those things directly on our statement of financial position and we end up with $475,000. Now, before we get to the journal entry, let's think about this $25,000. What's going to happen here? Are we just going to leave the $475,000 on our statement of financial position until the bond matures? Well, there's two reasons we can't do that. First of all, when the bond matures, at maturity, we know that we have to pay back the face value. Pay back the face value. So we have to pay back $500,000 to the bondholders. So we need the bond to be on our balance sheet or statement of financial position at $500,000 when it matures on, when does it mature? 10-year bonds. When it matures in 10 years, we need it to be at $500,000. So for that reason, we can't keep those issuance costs against it. Plus, these issuance costs do need to go through our income statement. We need to recognize an interest expense related to this. And so what ASPE permits is to say, well, rather than hitting the income statement all at once in year one, what you can do is you can straight line and amortize the bond issuance costs into your income statement over the 10-year term of the loan. That will solve the problem of getting rid of this $25,000 that's offsetting the liability to get the liability back to the $500,000 that we need it to be at maturity. And it will enable the $25,000 to go through the income statement slowly over 10 years. More in order to match the cash flows from the bond or the benefit of raising the bond, which is going to be a benefit to the company for the next 10 years in the sense that they'll have that cash. So with that in mind, let's look at the question here. So the first thing we're asked to do is prepare the journal entry for the January 1st, 2020 issuance. So I think we know what we need to do there. So we're going to go debit cash, because Beansprout Corporation is going to get in cash, the net cash of this $475,000. So we're going to recognize the net cash here of $475,000, and we're going to set up the bond payable on to our statement of financial position as a long-term liability. And it's long-term because it's not due for 10 years. So that's our first entry. So this is at issuance. At issuance. Okay, so we've got that done. So let's see what else we've got. So then we need to recognize the December 31st interest payment and bond issuance cost amortization. Well, we also know that this bond at 500,000 will pay interest at 8%. So 500,000 times 8% means it's going to pay out, the bondholders will receive a $40,000 interest payment each year. So we know we're going to have to credit cash for that $40,000. That is a hard cost, and that's going to be paid to the bondholders every year of the 10 years. We also need to amortize the issuance cost. So we talked about how we're going to straight line amortize this 25,000. So if we take the 25,000 issuance cost and we divide it by 10 years, then we're going to recognize $2,500 per year. So this amount is going to be a decrease to the liability. Actually, it's going to be, sorry, my apologies. It's going to be an increase to the liability because we need to increase this liability. We have it at 475. We need it at 500,000. So we are going to be increasing it by 25,000 every year, 2,500. And the net of the two, or the total of the two, is going to be our interest expense. So this is going to go through our income statement. Of course, we know that this piece, as we amortize it, it's going to go through the income statement, and our interest rate, or the coupon payment, sorry, that we make to the bondholders is also going to go through the income statement. So our interest expense, or our total hit to the income statement, is going to be 42,500, which is the sum of our amortization of the issue costs and our coupon payment on the bond. And there you have it. Those are the two entries that are required in this question.